All right, we're going to keep things moving. We have our first panel coming up right now. So our first panel is going to be your biggest cannabis compliant risk isn't what you think. And I am so excited about this panel. It has great people on it, and one of my favorite moderators in the industry, a fellow redhead. Welcome, Jennifer Makris.
Wow, that was quite the introduction. Thank you, Lori, my fellow redhead. Wow, talk about way to kick off the morning. Thank you, everyone. Is everyone doing well? Amazing. Well, I'm ecstatic to bring out my fellow panelists to the stage. So if my fellow panelists want to come on out, Brad, Heather, Pete, and Ryan. Yes, hello. So our panel today, and thank you to the Ignited team, so Patrick and Elliot and Jason for entrusting us to be the first panel of the day, but also for assembling this esteemed panel. So thank you so much to the Ignited team for having us. Today's conversation, our kickoff conversation, is going to be talking about being capital ready, how Ohio operators prepare for financial partners and strategic buyers. As Lori said, my name is Jennifer Makris. I am the founder of Cannabis Cash Consultants. We are a firm that specializes in the security and physical movement of cash. And I also have the pleasure of representing Verdant Strategies as one of their strategic advisors. I would love my panel to introduce themselves. Well, ladies first, Ms. Heather, and we'll go down the panel.
I'm Heather Leitelt. I am the manager of the MRB program at Wright-Patt Credit Union.
Brad Bennett. I'm a senior director at Lazear. We're an investment bank doing ESOPs.
Ryan Freitas, the Chief Revenue Officer of FundCanna. We provide short duration, non-dilutive funding solutions to the cannabis space and have been in the space since 2021, but been lending for over 25 years, located in San Diego.
Hi, everybody. I'm Pete Karabas, one of the founders of Key Investment Partners. We are an equity fund. We've been in this space it's about 7 years now, primarily focused on preferred equity, convertible debt. We've done about 22 deals to date. Pleasure to be here.
Thank you so much. Let's give it up for our panel. All right, Heather, we're going to start it off with you. So what kind of different capital resources are there available for operators in this space?
Great question. So there's 4 of us up here on the panel today, and I'll kind of go over that a little bit. You've got your traditional lending, which is your banks and your credit unions. You've got your debt lending, and you also have your venture capitalists as well as your ESOPs.
And so to piggyback off of that, where do you think an operator can align themselves? What makes them a lendable prospect or prospect for lending?
Well, you've got to have a strong financial base in order to even get any lending in this space. You guys all know that at this point. And depending on what route you take, it really is depending on what your business structure looks like and what you're looking for your business. But you're going to look for more of a relationship if you're going traditional. And then debt is just going to be straight if you're looking for financing, no other strings attached, I should say. And then, if you're looking to build out your business and give some back to your employees, you're going to go further into the ESOPs and things like that.
And I'll actually open this question up to the rest of the panelists since you each represent a different function of being capital ready and lending. So any comments to the 3 of you in terms of how an operator is ready for banking, ready for lending, what they should do to prepare. And as Ohio is a medical market and an adult use market, the medical market has been live since 2016, I believe, and 2024 for the adult use. So do you think they're really positioning and getting themselves ready for exit or for lending or to be capital ready? That was kind of a loaded question.
Yeah, I'm glad to start with that. I think the first thing is having stable historical financials, strong margins, clean books. That's just table stakes. I think at this point in the life of the industry, we've seen a lot of state markets go boom when they go adult use, taper off. We see pricing compression. So investors are familiar with that. And certainly on the equity side, it's one thing we're very focused on. In a state like Ohio, adult use is relatively new compared to some other states. So we want to see stable cash flows over a long period of time, a couple years, and I think that's the most important starting point.
Yeah, to kind of piggyback on that, we're looking for obviously stable cash flow. I mean, we're a debt provider, and we're really focusing on the top line revenue. We want to put out an offer that's going to be somewhere between 6 and 12% of that top line revenue to make sure that it's an offer that can be serviced. So between the revenue and between the cash flow, those are really two of the metrics that we're focusing on.
Yeah, and I have a little bit of a different perspective. Obviously, I'm on the sell side. So when we're selling to an ESOP, we're raising capital for the companies itself. And so, a lot of what we're looking for, to their point, is stable cash flow, but also a good story that we can sell. Because ultimately, look, companies kind of ebb and flow in performance, and we need to get these lenders comfortable to come in there and put some money to work and take that risk. And so we want a story behind the numbers and be able to explain why we think they're going to be able to get out of the deal.
So Brad, I would like to kind of keep this question with you because I would like to talk about what ESOPs actually mean. So in layman's terms, in a 101 kindergarten level, can you explain what that means to our audience?
Yeah, absolutely. So ESOP stands for Employee Stock Ownership Plan. So it is a way to exit your company. It's a liquidity event, and you're selling to what we call as an ESOP trust. So this isn't a farm where you're selling to your employees and the gates are open and the employees run the company. It's a trust where the ESOP or the employees are a beneficiary, and post-close, the company continues to function exactly how it was, except now there's a liquidity event in place where you're going to get some level of cash at close, and then the rest is seller financed.
And why would you say that's becoming a real exit option for cannabis operators?
Well, the reality of the situation is there's not a great other option. The third-party market here only sells, Pete probably can speak to it, what he wants to invest, but typically less than 4 times EBITDA. In an ESOP, the beautiful part of it is the buyer is required to pay fair value. How do we define fair value? Well, fair value is going to be based on a valuation done by the third-party buyer. And typically it's weighted towards what we call as a DCF model, or a discounted cash flow, where we're looking at the next 5-year projection, putting a terminal period on it and discounting it to today. And so typically in those types of models, you're able to get anything from 6, 7, 8 times even I've gotten on deals in this space. And so I would tell you, when you have that as your option, although there is a big seller finance piece of this whole thing, it's a lot more attractive to the investors and owners to get a liquidity event.
Thank you for that. Pete, this question is for you. How should operators think about the cost of capital versus the access to capital?
Yeah, so in the cannabis market, I'm sure many of you are aware of this, the capital markets are very tight, whether it be debt or equity capital, they're very tight. So if you don't have a strong business with stable cash flows and what I would call table stakes, you may not have access to the small amount of capital that is in the cannabis industry today. Of course, we're all hoping that's going to grow significantly in the coming years. That being said, in terms of the cost of capital, I think the most important thing is to think about why you're raising capital and what the use of that is. If you're going to raise capital, with Ryan and FundCanna, for example, that's very different than if you're going to raise capital from key investment partners and we're going to look at preferred equity. I think it's also important to really understand the full cost of whatever capital you are raising, whether that's debt or equity. And if it's debt, what are the costs of the warrants and the covenants and et cetera, over the full term of that capital. If it's equity, what is the true cost, even when it comes to board governance and dilution and all these small things that make up the true price of the dollars that you're accepting into your company.
Thank you for that. Ryan, for what kind of debt structures are you seeing more and more happening right now?
Well, the good thing for us is there's not a lot of debt providers in the space. So when we look at different structures, it's really based off of the products that we're providing. And so we pretty much, we offer a line of credit option, and then we also have pivoted over to more of like a, well, I wouldn't say pivoted, but we also offer an inventory finance tool called Buy Now, Pay Later, which works more like, it's called Ready Paid, but it's a Buy Now, Pay Later that really is used for purchasing inventory. So we're offering operators the ability to finance their inventory and really finance that gap in time when they have to outlay capital until they receive revenue. So we're seeing the behavior change from kind of our core product and move into the tool that's used more for inventory, and that's kind of what we were hoping to see. Other than that, if it's asset-backed type financing, a lot of that stuff, we don't handle it, so we're happy to introduce some of those clients to others.
I think that's what's really great about everybody on this stage is that we know our lane, we know our area, especially if there's something that we cannot support, we're connected to, we want to make sure you are with the best fit for what your current needs are. So that is really great. Thank you for that, Ryan. Heather, your Wright-Patt Credit Union is here in Ohio. So what are the things that you are seeing from your perspective, from a capital perspective in the Ohio market?
From a capital perspective, with traditional financing, generally what we do is we do lend on hard assets, so a lot of real estate, but we do have other products. We've got equipment that we lend on. We also have some lines of credit. But at the core of who we are as a credit union, it's about community and servicing the community and making sure that you, as part of that community, has an option and has a voice. That's one huge part of Wright-Patt that a lot of our members appreciate. The cost of capital with us is not necessarily higher interest rates. They're normally much more attractive. The covenants are more like regular traditional commercial lending. And what you get from us, from doing business with us, is more of like a white glove service. We have a small team that will work with you for everything that you need. So it's us against the world, kind of, so to speak. But that's something you'll get from credit unions. When you invest in us, we reinvest in you and we reinvest in the community. And that's something that I think really sets us apart, is that relationship piece.
I think that's what sets a lot of people apart, right, is building that relationship, that credibility. And what we've heard so far on the stage is obviously giving back to the community, meeting the members where they're at for the credit union, but also the story, right, the community, the story, the long-term plan. For everybody on the stage, tell me about the biggest opportunities and the biggest risks that you are currently seeing in your perspective lane of being capital ready, debt, venture capital, ESOP. What are some of the biggest challenges and risks? We'll start at the end with Pete.
I think in terms of the opportunity set, one of the biggest challenges is really finding businesses that have been run, have been stable, have strong management teams, and that have clean books and can give us enough confidence to deploy capital. Also have a clean cap stack. I think today in cannabis, a lot of capital was raised in 2019, 2020, into 2021. And then since then, it's been just a fraction of the amount raised and deployed into the industry. So what that has really created is a lot of cap stacks that are challenged in one sense or another. They've raised at too high valuations. They have too large boards. They're kind of stuck with a certain valuation they're trying to achieve, but they can't really raise incremental capital. So to get over some of those hurdles, even in fundamentally good businesses, I think can be challenging. But it's sorting itself out slowly but surely.
I think for Ohio specific, the biggest opportunity is really the growth. Since adult use was introduced, we've seen 150% growth in the market, which is super exciting. That shows that the operators are getting out of this survival mode, moving into more stable, and then often moving into more scalability. For us, we want our product to be growth capital. We don't want it to be a lifeline. So if we can add fuel to the fire and help support the growth, that's when it's exciting for us. The biggest risk on the other side is actually sometimes the same thing, the growth, because what we don't want to do is take a look at the growth, get super excited about it, start lending on that future production that we may overestimate, and then we can over leverage the client. So it's kind of a double-edged sword there.
Yeah, from an opportunity perspective, I mean, I think the industry has gone from a period where there wasn't a lot of options for a liquidity event. And so the reality of the situation, ESOPs have always been around, but, as they become a little bit more prevalent and we can educate people on what they are, what they mean, and why they're a great exit opportunity, there's an opportunity here in Ohio as adult use has become effective, and you're seeing this growth, and it's like, when do you want to sell? Investors want liquidity at some point, obviously, and a lot of these companies have outside money in there. And so the reality is finding that perfect time to sell, because you don't want to wait till you get to the top and are coming back down. In those scenarios, we can't sell the future. We want a good story of where this is going, and so finding that right time is important. So I think that, the opportunity and then the risk is waiting too long. You need to be able to sell at the right time, because ultimately, as soon as we start seeing things go down, it starts adding a lot of risk into the buyer's mind on what they're going to pay.
I have to agree with Ryan on that. Coming from a credit union, we are Ohio-centric. So the growth is great for us, but it's also limiting at the same time, because we can only service those in the state of Ohio at this point. So, keeping up with the needs of the industry is something that we really strive to do. We've been working on working towards new products and services and stuff as the growth continues. But Ohio growing is great. Unfortunately, we can't enter into Kentucky and help Kentucky at this time, but those are things that we're looking at possibly in the future.
It's interesting, we're here talking about Ohio, which is a wonderful market, and Kentucky is right next door, right, a newer market. And so what we've chatted about so far, how does that differ when we're talking to can I get a show of hands? Who here is from Kentucky? Who's an operator in Kentucky? All right, so how does we have one at the back, just one? All right, Ohio operators. You're out, okay, 2 to 1, okay. How do our conversations differ for those that are in the Ohio market and who have been operating again maybe since 2016 on the med side? How does that differ in preparedness to perhaps a Kentucky operator that might be looking for that long-term strategy? I'll open that up to anybody.
Well, for us, Kentucky is probably still another year and a half away before those conversations get exciting for us. It's too small. The operators are just getting going. We really aren't interested, not that we're not interested, we're not capable of actually funding a pure startup. We want to see at minimally 6 months, but get a bit more comfortable at about a year of revenue generation. So the conversations in Ohio are exciting because they're off and running and we can actually help support the growth. The conversations in Kentucky are more along the lines of, let me go find somebody else who focuses on that.
Right. I would add exactly to what Ryan said. I mean, I think it's important to find who the right fit is, of course, when you're raising capital. To Ryan's point, even on the equity side, it's too early stage on the Kentucky side. Ohio's exciting for a lot of reasons. We've been watching Ohio for a long time. It has years of operating history, a clear license structure, a lot of things in the market that point towards growth and certainty of cash flow. So it's just two very different markets, and it's something we talk about in cannabis all the time. Across the U.S., every market's different and in a different stage of its growth.
I would say for us, despite the fact that we can't bank in Kentucky, we talk to a lot of potential businesses in the industry in Kentucky or any other states, as well as other credit unions or community banks that are looking to get involved. And we, again, tight-knit community with credit unions, we support each other. So we have a vast array of people that we can kind of, pitch it over to and just help find the right partner for that partnership.
I think probably for any Kentucky company that's just in the early stages, an ESOP's probably not right for them at this point. But I would tell you from the big MSOs who are looking to get out, it's just one more piece of growth that you can put into your projections that I think will help drive value.
That definitely makes sense. We talked a lot about, cash flow and margins. So what are some of the other metrics we're looking for when we talk about leveraging debt, venture capital? So what are some of those other metrics aside from just revenue?
I guess discipline, cash management. We also, we're hypersensitive to the bank statements. We're looking at what's revenue versus what's fundraising, even though maybe some of the cash looks like it's dependable, but if it's coming through fundraising and not through true revenue, then it's hard for us to get comfortable with that. We also want to see that the expenses are pacing accordingly. If a company is burning too much cash too quickly, we're probably not the right tool for them.
I would say also, a big thing that maybe not quantitative, but it backs up the quantitative story is really just having a niche, whether that is being in a limited license state, whether that is you have a cost advantage at the grower processor compared to other MSOs. Is it scale? Is it you're the best, you have the most retail locations in a given state, and it provides you kind of the best performance because of that? Are you in better locations than others? So it's finding things that kind of differentiate you from your competitors that really help kind of sell your story.
I would say for us, everybody loves a good balance sheet up here. I don't think anyone doesn't. But for us, as a credit union, we look at your involvement in your community. We look at how many jobs you're going to bring to the community to help further stabilize that community. Things that you can do that are off of that balance sheet. Things that you do personally, professionally to help Ohio.
I hope everyone heard that, right? Because that question was really important, because looking at the other metrics just outside of those operational metrics and the revenue. So it was, finding your niche. Are you in a limited license state? Are you telling the story? Are you providing, good community involvement, employment opportunities? So those other things just outside of revenue really do carry weight. So I hope everyone, heard that. And thank you everyone for touching on that, because that was really important. If you could give advice to an operator that is looking for a, say, 24-month exit strategy, what would you advise them of today in preparing themselves for that 12 to 24 months out? And is that the right time period?
It's never too early to start thinking about it. I would say that. Look, I would say call me, but the reality is starting to have conversations. What is the exit strategy? When's the right time to sell? Learning about your options, right? Some of this is education just as much as it's, all the other things. I think, we really value ensuring that whoever we're gonna engage as a client, they really know what they're getting themselves into. So we go through as many education sessions about ESOPs in general. And look, ESOPs aren't for everybody. And I'm going to be the first person to tell you if an ESOP isn't for you, because I don't want a client that's unhappy. That's not good for our brand, and that's not good for the experience. So I would tell you it's never too early, but start dialogue, start conversations, reach out, and we can talk what that looks like.
Yeah, I can add to that a bit. I totally agree with everything Brad said. I think really focusing on the same note on your operations, focusing on building strong margins that are going to be attractive to a buyer. I think also it's never too early to identify your buyer pool and your options. Are you building a single state operator that, in theory, you plan to sell to a multi-state operator or a strategic buyer? Are you building a business that you're planning to hold on to for 10 years? Are you understanding all the options that are even available or what buyers are even out there? And really building that knowledge is critical, because it's not going to happen overnight. It's not like you will get to a point where, okay, this is the exact right time to sell and there's the buyer I thought was going to show up. It's about a continuous evaluation of the options available to you. And if you have a strong business that's attractive with reliable cash flows, eventually somebody will be looking to buy it. I also would say, to the 12 to 24 month question, it depends on the business. Generally, I would say probably call Brad. That's a short time frame. But Ohio is getting to that point where you can underwrite the future. You understand, the investors understand the market. It has enough operating history. And so if you have a good story behind that, you can look like an attractive acquisition for the right party.
I would say on the traditional side, just be transparent with us on what your plans are and bring us along on that journey so that we can help support you, not just, for your banking needs, but also for your compliance and regulatory needs. We know how the DCC works and, what time it takes for them to transfer ownership and all of that other stuff. So if you include your financial institution in that, we can help further support everything to make it as smooth as possible.
Yeah, so we don't necessarily focus on the exit, but I will say if you are planning to exit, a good way to make yourself a bit more attractive is just by growing the company and having access to capital, which we can help provide. And if it's a flexible instrument and we're not taking any control of the business, it's a great way to be able to grow the company, make yourself look more attractive so that when you are ready for an exit, somebody's actually looking at you.
I think it's really important because we spoke a lot about exit and funding, but also to your point, Ryan, it is the cost to cover the access to, the capital to cover the cost of those capital investments, those equipment and purchases. That's really important as well. Is it fair to say that each of you are looking to deploy capital across Ohio and Kentucky? Are all four of your firms?
Yes, we are.
Okay.
Yeah, we're nationwide, so if we're in 18 states across the country. We've done 70. We're going to do 70-something ESOPs across multiple industries. The cannabis industry is no different for an ESOP, and so we're willing to operate wherever you guys are.
Yeah, same. We don't have any geographic restrictions. So as long as the company is growing and is an attractive company for us to participate and help the growth, and then we're excited to support.
Yeah, same answer over here. I mean, we are state agnostic. We invest all over the U.S. For us, it's really the stage of the company and the profile of the company that we're evaluating. Ohio's a great state, as a lot of us said before. I think Kentucky is certainly a bit earlier. But there's nothing that would stop us from investing on the Kentucky side in the years to come.
Well, we've been at Ignite It for about an hour or so, if you made it to the networking this morning. And one thing that I think is interesting that we have not discussed is almost the elephant in the room, the rescheduling conversation. So what's interesting is that we had our panel prep call the day before the announcement was made. So this is kind of not a scripted question. So my inquiry to the panel is, does anything change from the position of funding or exit strategy as it relates to the impending rescheduling?
I would say no. Being on the traditional side, we are trying to make sure that our program is more traditional anyways. So we don't lend on product. That's not going to change. It's not federally legal. So everything would probably be status quo for traditional financing.
I mean, I hope so. It is early. I mean, the reality of the situation, and I think everybody kind of knows it here, is we're still trying to figure it out. And that's okay, but I look at it as an opportunity. I mean, I have clients that think one of the big options are hoping that credit cards can be used going forward, and they think their sales go up 10% just by doing that. That's part of what we're going to sell. Obviously, whether that happens or not, I don't know. More to come there, but we're hoping it's ultimately a step in the positive or in the right direction, and where it goes, we'll learn more in the future. But I think today it's tough to give a, a specific answer.
Yeah, I agree with you. I think there's obviously a tremendous amount of optimism, and it's a great opportunity. I think it has the potential to change everything. But in the immediate future, it actually changes nothing today. We're still kind of a wait and see. How does it all look? Is there going to be bifurcation between adult use and medical use? We don't really know how that's going to play out. I do think that in the long run, because it is exciting, something definitely changes. More access to capital will enter the space. Now, does that mean banks and credit unions all of a sudden get ultra excited about lending to cannabis operators? I don't know. But I think what will happen is they'll provide debt to companies like ourselves to be able to then extend that out to operators. So the same people that they may turn down, they may actually provide money to us to say yes to.
Yeah, I would completely agree with that too. I do not think rescheduling should be thought of as this immediate change to the market. It's not going to change anything how we're deploying today. That being said, over the next year, and we're already seeing this, and even with the executive order back in December, it's something the industry obviously really needed. The industry struggled for several years, and we're seeing interest from investors to come into our fund. So to Ryan's point, it's a big domino that has fallen. It's going to take some time to see exactly what rescheduling means, what it looks like. But it's a huge positive for the industry. We're optimistic very much going forward into 2026 and beyond, and are very excited to get some clarity and some certainty in this industry. So.
Thank you all so much for your time. Thank you to my esteemed panel for joining me this morning. Everyone, I hope you enjoyed it and found a little bit of value in the conversation around being capital ready, and we hope you enjoy the rest of your Ignite It Ohio Spotlight experience. Thank you.
All right, thank you to this panel. Give it up for Jennifer.